Hi, welcome back to another episode of the South Texas Power Lunch. I'm Matt Duke from the South Texas Business Lawyers. And today we're going to continue a second part of our discussion regarding buying and selling businesses. And to do that, I've got Malcolm Pease from Tsetserra Partners, who is going to talk a lot about, from a buyer's perspective, how they engage with deals in their target audience. And if you missed the episode that we had, that was our first part on this, on what it takes to actually get a deal in principle, go ahead and just stop right now. Go back and watch episode one because we're on a long journey here and we're at the halfway point and we're going to be getting to the end where the deal gets done. And with that, I want to bring Malcolm back on here so that way we can continue this journey. How are you, Malcolm? You doing all
Hey,
right?
yeah, hey Matt, thanks for having me again. Appreciate it.
Absolutely, absolutely. So last time when we left, we were working through the aspects it gets to get a deal in principle through a term sheet, a letter of intent. There's some other words that it goes by, but now we're going to go ahead and continue that journey with we've got a signed letter of intent term sheet with the deal principles that are on there, and now we're going to be working to a definitive agreement, some sort of purchase agreement.
Yeah.
What do you think is, or help me understand from the buyer's perspective? What is one of the biggest shocking things for sellers when they suddenly now go from that term sheet to negotiating the definitive agreement? Is there anything that you've kind of experienced with that?
Yeah, I think the kind of the overarching status of where the business is at, and not to get too into the minutia of like it's a stock deal or an asset deal at this point, but getting a real clear picture of where the business is at in its current date. Because in an asset purchase, it's going to go essentially from one entity to the other entity, and there has to be a beginning process for the new entity of where it was previously. And
Right.
just by way of saying, arbitrarily, we have this much inventory, we have this much in machinery, all that kind of stuff, and not having that really relatively defined can be a challenge. Not in every single deal, depending on the size, do we, get evaluations or a real baseline of what those quality of those machineries might be. But at the end of the day, we want to have a relatively good picture of like, are we in the right place? Because there is going to be some allocations that go to that within the agreement. And we want to make sure that everybody's on the same page because it has a tax implication long term, both for the seller and the buyer. So that's that one point where I want us to try to get around, and it's not just something I feel like you can just arbitrarily talk about or neglect. I think it really needs to happen.
No, I mean it's absolutely right. And the experience that I've got, with a lot of my clients and that target is they're owner operators, right? And a lot of times, and this is a different way that they've never looked at their business, but it's what they
Mhm.
have to do in order to draw that line of what we're buying. And for simplicity's sake, we're going to go down the path of doing an asset purchase. That way we don't have to talk about too many permutations here. But basically, just discussing of if there's a buying or a sale of all the assets of the company.
Yeah.
But yeah, I get that as well. What I want to take just a second to do as well, Malcolm, is when the lawyer for a lot of small, medium-sized business owners that are buying and selling businesses, you can almost use the agreement as a roadmap of the discussion points and the path to get there. For example, usually the first part there is to describe the assets.
Hmm.
The second part is to talk about the purchase price, that value. And it's not always just someone will write a check or wire funds to another party. There can be something there.
Yeah.
There's things like working capital adjustments and stuff that we're going to get to in a second. Next thing we usually have is representations and warranties. And what I educate my clients on is this is where a buyer, if you're selling the company, is saying, I need you to tell me statements of truth.
Hmm.
And if they're not true, then you've got to tell me why they're not true, because these are the statements that I'm going to rely upon in buying this business and giving you that purchase price. And, I've got deals where the representations and warranties, which we'll come back to in detail in a second, is, 40 pages long.
Yeah.
I've got some deals where it's 2 pages long. Every single deal is different, but the buyer and seller, usually buyer has a little bit of representations they're making, but the seller is usually asked to make statements of truth or say why it's not true, which we call exceptions that are on disclosure
Mm.
schedules for a variety of different factors. Then the next part we usually have is covenants, and these are promises. These can be covenants to, do something in the future, maybe operate your business in a certain way if we're going to do a sign and close, which we'll get to in a second. Or it could be some sort of restrictive covenant, which is a promise to not do something after the close of this document, or a close of the deal. And then the last part is the indemnity. And if people are starting to get a little bit glassy eyed, yes, I know it is a lot, but just take those concepts at just a high level. That is the framework of getting a deal from a term sheet to a close right there.
Yeah.
What are your thoughts on that? Am I missing anything at a high level?
No, I thought you said it really well. I think that you're right. People get exhausted or glassy eyed as you go down the list of those, and because it is quite an undertaking to get through all of it. I really like the way you said on the reps side of things. It's the promise that these things are true, the affirmation that these things are true. I think that's really well said, and I probably steal that to be honest with you.
Go for
Um,
it.
and so, but I think starting at the beginning, like what are these assets, define them becomes really, really important, particularly because, again, the business is operating already and there's
That's
cash
right.
sitting in the business, there's receivables, there's payables, all of the above. And let's define what is the business, the new entity actually taking from the old entity in the asset purchase is the way I like to look at it. And that can be a tricky conversation because there's things in progress, there's things to be figured out. And if you're, like most of the people that I interact with, there's a lot of things that are unknown. I like to I like to say a lot of business owners operate their business out of their checking account, and I'm having them have to operate out of a proper QuickBooks or a proper accounting process. It can
Right.
be a bit of a challenge.
No, that's absolutely right. And you know what? Let's kind of just jump into that, from that framework we talked about. So, usually what the first thing is, we have to define with particularity usually the assets, right? And there's the easy part of that. There is the hard assets, if there's real property, if there is leased property, but then we get into the really gray area of like, okay, customer contracts or
Yeah.
vendor, arrangements. What if there's, WIP, work in progress, if we're actually, manufacturing some sort of product? How do you guys, view on trying to get with a potential seller to really define the scope of the assets that you're buying?
Um, by and large, we try to take them for face value initially and see how far off we are from one another. Typically, hopefully, we're not too far off. But if we're saying, we're in progress to produce this potential purchase order and we've only done this much of it and there's this much outstanding, well, the likelihood of them actually doing kind of in cost measurements of their manufacturing process or their fabrication process or whatever is very slim. And so as a
Right.
result, that can be a tricky process where I'm saying, well, hold on a second. You told me that when we were going through due diligence that, it only takes this many hours to produce this widget. And now you're saying that you've produced this much widgets at this many hours. Wait, hold on. There's a bit of a step up process that's happening here. So that's where we get hung up a little bit, is this misalignment of you marketed it one way where it looks really great because there's this great margin and there's limited hours and you can produce this and there's all this potential upside because you're leveraging all these great people to be able to produce this amount of quantity. And then now we're going through the work in progress and you're saying, well, hold on a second, they've actually been working on it for the last 4 weeks and it's taking longer than expected. Well, truth be told, like if it's really possible to do what you presented in the due diligence process, then you really took your foot off the gas in the process of running this business through due diligence or on this particular project. So those are always very hard sticking points. The whip one's really tough. Concurrently, understanding ahead of time during the term sheet and the LOI about how you're going to handle receivables, I think is a really tough conversation that always has to happen, because it may take a while to receive those, or it may be that the owner is no longer involved soon after the transaction. So those are some of the sticking points I find that it's real cash implications for folks that tend to be a little bit more tougher of a conversation.
Which is something I experience all the time, and that kind of moves us to, on our framework, to the second part, the purchase price. Because we talked about in the last episode, things like earnouts, where if there's value, trying to bridge value gaps between buyers and sellers, or the ability to incentivize somebody to go on into the future. That we've already talked about, and those are things you put in there. But what, to your point, and this happens a lot in our clients that we're dealing with, is I've got AR, accounts receivable, Some of it's aged. Some of it, could become bad debt.
Hmm.
I've got, work in progress. I've got or I've got a in process project that
Yeah.
I'm doing right now. And those are pieces of value that, can have things like working capital adjustments. Because when you buy a business, I had this conversation actually yesterday with a client. I'm like, okay, we're buying this business. This business is worth $1 million. Okay, how much cash does the seller, do you think, because they know the answer from diligence, keep in the bank? About
Yeah.
$30,000. Great. Do you have $30,000 you're going to put in the bank? Because the day after you buy it, you now need to have 30,000 because that's what they think on there. They're like,
Yeah.
well, no, I don't know if I will. Or how do I know that that 30,000 is the right amount of money? Because they do have money coming in and money coming out. And, again, we say this a lot, and I'm sure we're going to keep saying this a lot. You can do a whole nother episode on working capital and how to
Sure.
address that, right? But for you as a buyer, I mean, I'm sure that's one of your biggest challenges you get into is making sure that the cash flow of the business, because overnight it changes
Yeah.
ownership, can be consistent because that's what you're buying.
Yeah, I mean, to make it real for those sellers out there and buyers, you don't want to miss payroll. Like that's the thing I think
Right.
about, right? Like there's an
Yeah.
implication day one on a payroll perspective, and I find that just talking out in the ecosystem and interacting with business owners that have sold to other folks or whatever the case may be, like that's one of the things that always kind of trips up. Like, oh my goodness, payroll just shifted, and there's a check that's supposed to go out in the next 2 days. Like, how do we
And
handle
where's the
that? How do
money?
we
Oh my
manage that?
gosh. Yeah,
The other
exactly.
one that we run into, just with the level of sophistication and types of businesses we interact with, is that often there's a lot of, we sent a check to a vendor to pay for them. They haven't cashed it for whatever reason, or they're a small shop and that they're sitting on a check for whatever reason, and then come to find out that the vendor comes back and they're like, I never got paid. Well, so it's just what it is. So
Right.
that we always try to, again, there's other areas to protect yourself, but that's one that we try to solve for. Like, hey, there is all this payables that you say have been paid. Part of the agreement is that you are going to pay off the payables in an asset purchase. Are you sure? Have you really
Right.
done this? Have you've committed to the following thing far out into the future that's going to have implications on the business, whether it's a commitment to purchase a certain amount of widgets or whatever the case. And so,
Right.
have you actually done that? What does that look like? And so that's always a tricky one. And you want to, as a small business owner, you want to maintain, those relationships with your vendors, keep it as stable as possible for your employees. So all these types of questions have to happen.
No, I mean, it's absolutely right. And, we've talked a lot in the episode about how organization can save you money. The reality is these kind of working capital adjustments or issues, even if you're very much on top of it, it's something we have to address in the terms of an agreement,
Yeah,
that are out there. Now, if you haven't got yourself organized, you're going to take that same thing and multiply it by 10 in trying to deal with
sure.
those, because I can't tell you how many times, a client on the sell side will go, well, exactly how much money am I walking away with? Well, when I've got purchase price adjustments and working capital adjustments that are, sometimes again, they're there because of the structure of the business and they're
Yeah.
appropriate tools. But when they're usually there because of it's the right business and we have no clarity into that,
Hmm.
the answer is we don't know.
Yeah.
And that can be very hard for a seller to identify, is that the number that was on that term sheet is not actually the number they can confirm they're going to walk away with because of that
Sure.
risk allocation.
Yeah, that's totally true. And it's an educational thing. And I was there at one point too. I was learning it from the reverse side too. How do I do this in a sensitive way? Given the ethos that we try to portray out to the world of taking care of these businesses, but at the same while, like these are awkward and tough conversations that potentially will only happen once for this seller ever in their life. And so
That's
it's
right.
just tough, and it's an education aspect for everybody. And it's important, to the seller and to any buyer out there. It's important to have the right kind of teammates around you to be able to get the deal done, that understand this and know that there's ebbs and flows of educational challenges, as well as like, I don't want to hand that off, or I've discovered this, or so on and so forth. It can be, it's an all around, a process for everybody to get through.
No, that's right. And what Malcolm was saying is have the right attorney and right accountant
There we go. That's
with
right.
you,
I
because
love it.
they can make all the difference. And we could talk a lot. I want to mention one more thing about the assets, and then let's move on to the reps and warranties part. But another thing that comes up a lot in deals that people don't realize is you're transferring assets from the seller to the buyer. If there's any sort of documentation that prevents that, that
Mm,
usually becomes a big scramble. And these usually come up of, well, I have customer agreements. Well, are
that's
your
right.
customer agreements assignable?
Yep.
People go,
Great,
I don't
great,
know.
great point.
Well, the reality is almost most of the small, medium sized business owners, they really don't know. It's whatever the template is that they used is what it says.
Yeah.
And so that can be a real aha of, well, you're buying my 150 clients, but wait a minute, I have to go get permission from all 150 of them. And then we get purchase price or adjustments and those things.
Yeah.
Same thing with vendor agreements. Vendors in a lot of these, longer standing relationships give preferred pricing. And that
Yep.
preferred pricing says, hey, we've been doing business for 30 years together. You give me a cut. But if that agreement is not assignable, or it has easy outs that make that a risky situation for the buyer, that's
Hmm.
an asset that becomes now a discussion point through the diligence. So just understanding some of those kind of subtleties, which are very common problems, by the way. So if you're watching this, think to, do you have something with your vendors or with your customers that can prevent some transitioning? It comes up a lot that can
Yeah.
move on those assets.
There's so much. I'll just speak to one thing. There's so much.
Sure.
There's so much at the beginning that gets perceived or gets presented to you as the buyer of positive aspects of the business. Then you come to find out, oh, so and so had a handshake deal circumstance. That thing's not going to last post transaction. So
Right.
that definitely is one. The other thing that I would say that comes up from time to time, just to take in mind, and again, it's not an asset necessarily from a true sense, but how easily can we change the lease ends up coming up quite a bit in the conversation points is, hey, the previous owner thinks, we'll just transfer this lease. It's an existing lease. But no, that leaseor wants to
Landlord
be
goes,
able
I
to,
can get an extension and I'm going to get a
exactly.
rent increase from the new buyer almost every single
Yes.
time.
Yep, and it becomes an implication for all people involved, and so, yeah, that's definitely been one of them. There's times where we won't agree that to the new lease terms are, it makes it really challenging. So, yeah, there's that's that aspect I think for a seller just to take into consideration. You've got another party involved if you don't own the real estate that you also have to somewhat negotiate to get the deal done, and so just keeping
It's a
that in mind.
great point. That's a great point. I sent off a lease for an acquisition. It's the last thing we need to
Yeah,
get our deal done today. So no, that is
awesome.
that is so truthful, so truthful. Let's talk about representations and warranties and indemnity. And again, I'm going to slow it down just a little bit from an education standpoint. So again, reps and warranties, these are statements of truth. The example I always use is, and on a variety of different subject matters regarding the business, the easiest one is there's usually a statement that a seller is asked to say as truth is that there is no litigation
Mhm.
that is ongoing. Now, there's a whole lot more to that, but let's just stay with that statement. If that statement is true, we're great. We're making that representation and we're going to warranty, meaning we'll stand behind that statement is true into the future.
Yeah,
All right. Indemnity at a most highest aspect says if the indemnity says that if I am damaged because that statement is not true, you will make me whole and you will
yeah,
make me whole versus any attorney's fees usually or any damages that incur. So let's take my example. If I say the statement is there is no litigation, but there is actually a lawsuit, and the day after we close, they sue the buyer, then now I'm going to be on the hook to indemnify them for the damages that they could have to pay, including there's attorney's fees. So at a very high level, there's statements, and usually we have statements regarding financials, employee relationships, benefit plans, real estate, leased assets, intellectual property. I mean, again, I think, as I said at the earlier, right, I've had one that are 40 pages long worth of reps and warranties, and I've had them that are 2 or 3. But
yeah.
this is, I would say, the most critical piece of risk allocation because the buyer is relying upon these statements through their process for the truth in order to make sure that they understand fully what they're buying. And so it becomes a critical conversation for the buyers. Malcolm, how do you guys view the reps and warranties, and how do you guys approach them?
Yeah, I mean, there's many ways and many things that come up in the conversation. I think the big part for me is it is my one of my biggest tools to mitigate some of the long-term risk or sometimes the immediate risk of the business that didn't get disclosed, all of the above. One of the things that we struggle with the most is as much as you would like to think that a new owner coming in, is going to be on great terms with a vendor or great terms with a customer or all of the above, there's always that circumstance of like, I loved working with so and so for the last 2 years or 5 decades or whatever it may be. But now there's this change that happens, and we're not going to give you the same circumstances that we gave before. Or, hey, that warranty thing that we've never brought up before, all of a sudden it's going to be brought up because we know we have a claim on the contract that was signed with the last owner, and so that's the ones we
Right.
run into. It's like
Yep.
we manufacture something, we built something, we installed something, and we've guaranteed it for the next 5 years. It's like, okay, so we're walking into that circumstance saying like, is everything okay? Oh, all of a sudden so and so has, come out of the woodwork. Yeah, I have this issue with the thing you gave me or supplied or serviced or whatever. And
Right.
so how do I mitigate that? Because it's going to be real dollars out the door for me along the way if all of a sudden they pull a warranty claim and it was a guarantee from the last owner who's no longer in the business any longer, has got liquid on their cash, and they're off sitting in Rockport, Texas, or whatever it may be. And so, that's a real issue for us that we run up against, that I try to communicate. Like, here's the circumstance. Are you truly communicating everything you can at this point, to avoid awkward conversations later?
Well, and from a reps and warranties, again, one of the things that comes up a lot too is how comfortable, even when there is disclosure, because and I failed to mention this earlier. So let's say that my litigation statement was not true, like there is
Hmm.
litigation.
Yeah.
Then usually what comes along with the reps and warranties is a disclosure schedule where we would say, except as listed in the disclosure schedule, there is no litigation.
Yeah.
On the disclosure schedule, we would say what the claim is, such and such is suing us, or we're suing such and such. But through this process of representations, warranties, and disclosing that happens through the diligence, more, the more advanced diligence stages, then a lot of these things come up, and it sounds like you guys then can address things where, okay, maybe there is risk no matter what we do, no matter what
Yeah.
statement is made, that we believe we have. How do you guys try to make sure that you can go back, and if there is that warranty claim which you feel that's out there, be able to get your damages or whatever
Yeah.
that cost would be from the prior seller? Do y'all use holdbacks? Do you use escrow, anything like that?
Yeah, we definitely do. Again, we negotiate the terms, and we also negotiate the final price. So it's a case by case situation. I like holdbacks. It's very clear defined. Escrows are, clear defined as well, but I like holdbacks from the sense of, here's the percentage, very clearly articulated. This is what we're going to keep back. Here's how we can count against it. Here's the procedures it's going to look like for us to report it. You have the following, amount of days after we've given this information to you to respond, all that kind of stuff. And, you
Yep.
know, we like to do that. I find that depending on the size of the deal, it's the larger amount or the larger timeline or whatever the case may be. I like to look at it from a year's time perspective because things just come up usually in the first 6 months. A vendor calls up, or litigation comes up, or someone got hurt and it was bizarre that they left right before you took ownership, and it's like, oh,
Right.
wait a second. So it's just things come out of the woodwork, and so I like looking at it from a year's perspective, from the holdback, and that just gives us enough time to know that we're getting comfortable. And sometimes I try to align some of the holdback depending on the warranties that are given, because that's just, again, in the industries that we work in, that's a big part of it, is they've committed to that customer, hey, we've got you for the next few years, or we've got this circumstance that we've promised to you. We want to be able to count against that, is kind of where we try to find that alignment. And I don't think it's an unreasonable conversation, but it often can be a thing that's not disclosed, can be the most difficult conversation after you've closed.
No, that's right. I mean, that's right. And in my experience too, on the sell side, holdbacks at this level are a lot more prevalent than an escrow. Escrows can
Yeah.
become expensive,
Yeah.
unless we're talking, usually over $1 million. The escrows are pretty expensive for that. But for our listeners, the reason why those exist is because the buyer is saying there is an inherent risk that I just can't be up on the air on. I mean, I'm going to make these statements, but like for example, the litigation, even though you've disclosed it, we think the litigation you're going to lose based upon what we know about it and have to pay $70,000. Well, we want to make sure Buyer does not have to pay $70,000. So we're going
Yeah.
to hold that back until
Yeah.
a certain time frame, and then if we don't, we're going to give it to you. And
Sure.
this is again how we can do some risk allocation, and we can do it with key contracts that are out there, employment issues, litigation. The list goes on and on for potential matters that are out there. And in my experience, and Malcolm, maybe you've got something different. There's usually some sort of level, but it's the ones that, because of disclosure later in the process, when this concept comes in, that becomes a real big issue for the seller going, well, wait a minute, now you're not going to give me that line item because of this. But
Yeah.
when you really break it down and understand from the buyer's perspective of risk allocation, most of the time it's a very reasonable ask in concept. Now, not always in dollar amount, but in risk in concept, to try to
Yeah.
mitigate that risk. I mean, is that your experience?
Yeah, I mean, I have to take some time after this call to think through, which is more advantageous for which party, an escrow circumstance or a holdback. But if you think about it from pure dollar sense, in a holdback circumstance, I basically have a period of time that I can call upon that holdback or make claim on that holdback for something that was unexpected or not disclosed. And so
Right.
as a result, I still have dollars out the door because I need to maintain that relationship. I need to, fix that situation with Texas workforce. I need to, whatever it may be, like those are real implications that have to happen and they're fires that we have to put out. So there's dollars that have to go out the door often to do that. And it can take a while, depending on the terms of everything, it can take a while to be made whole. And so, again, I got to think about from an escrow or versus a holdback. Maybe we'll change the strategy in the future. But, at some point, there's a real dollar implication that happens. And I want to be able to know that there's enough cash flow in the business to support its current operations, and potentially there's enough that's in there that we're reinvesting back into the business to be able to go do what we planned on doing and ultimately get kind of the outcome we were looking from the business. I think that's the other part, right? It's like you end up walking away with some good money. But if there was like excess that you were intended to have based on what you were perceived and you maybe paid the prior larger purchase price for that, ultimately I want to be able to have those dollars to be able to go do what I want to do and not deal with the other nonsense of that maybe holds back what we're trying to do.
No, I mean, and again, the indemnification properly done is to make someone whole.
Yeah,
It's not to penalize somebody. So,
correct.
and this is a conversation I have with people sometime. They're like, well, if something comes in true, I mean, do they just be like, "Oh, you lied to me. I'm gonna." No, it's dollar for dollar. I mean,
Yeah,
there are certain things that are reps and warranties which can be no harm, no foul. At which point in time, there's zero damages. So there's
yeah,
no, there's no, either you have to pay them or it's deducted from what's held back, and
sure.
eventually delivered. And again, at its highest level, if you look at it and said, well, if we rewind it and discover the issue, the buyer would have had to pay for, excuse me, the seller would have had to pay for it anyway.
Yep,
Think about like
that's
a
right.
house. This is another I use on that is, like, if you're selling your house and your air conditioner doesn't work, right? If you tell them that, you're going to have to spend that money to fix that air conditioner. But if there's a holdback for any issues and then they discover the air conditioner that you tell them about, it's still the same amount of money.
Sure.
You should have just told them at the beginning and fixed it, but you didn't even get penalized. I mean, you're at the same position. Both parties are at the same position that, they should have been at. One, the buyer because of their belief, and the seller because what they knew. So
Yeah.
it's an interesting concept of fairness on there. And it can get, I mean, I will tell you, it can get out of, fairness by using these procedures. But again, at its highest level, there's a reason for it there.
Yeah, I think that's really well said. I think the way I look at it sometimes is in an asset purchase, to keep it simplistic, is the owner is going to walk away with that cash that's sitting in that account, and they would have spent that money solving this problem if they hadn't closed by this date. And now we're
Right.
just solving it with a different set of money that they're still entitled to, just as they were entitled to the money in the checking account. But it's just reorienting when that ultimate thing that needed to be taken care of gets taken care of. So I think that was really well said. Well put, Matt.
Okay, perfect. No, no, I agree with you. And let me ask you this, because I know we're kind of running up on time here, but at a high level in reps and warranties, do you run into kind of a common conversation with regard to when sellers are having to go through the process of making these statements and disclosing things in response to these statements? Do you run into some common themes?
Sometimes it's a matter of, their lawyer or my lawyer wants to put something redline it into the document, and the owner says, "Well, I don't know. I don't know everything." So,
I've had that one many times. Like, I don't know if that's true or not. And I'm like,
yeah,
well, let's delete it. And then it becomes, well, somebody wants to delete it. Somebody wants it in there.
yeah.
What are we going to do? Had that
Exactly.
many
So that
times.
that can be tough, right? I think, and then the indemnity side of things, of like how much is the holdback, is often a question and conversation point. But yeah, that can be one. It's like, I want to make this true. I want to avoid, ruffling feathers later, or you don't want something to come up that shouldn't have come up. So they're not confident, and then ultimately in the day is how much money is actually going to be held back, because a lot of the time they end up wanting to just to move on. I mean, they want to be able to say, I did what I did, and I built this great business, and we did well, and I'm ready to hand the baton and move on. And so that's just the circumstance we run into. There's many other structures out there where people stay on for a long period of time afterwards. But in many of our cases, they want to be able to not feel like they have any confusion about what this looks like, moving forward. And so we try to make that as clear as day. And sometimes that becomes difficult because you try to get some reps that are in there that they may or may not actually know. So that's what's
No,
tough.
I've had those deals before where the reps are in there, and from a sell side, if the buyer is doing it, your lawyer's job is to, again, sometimes there are reps that are in there that do not apply,
Yeah.
you would say, well, if they don't apply, it should be no big deal. But there's also some that do not apply and shouldn't be in there, and
Yeah.
that's where again legal counsel can help on that for sure.
Yeah.
Let me, we're again just time on everything, and we mentioned as going through that framework there was covenants, and we talked about this last time about the covenants on restrictive covenants and non-solicitation. So I'm going to skip that, and for those of you that have not watched that first episode, I highly recommend that you watch part one of this, because we talk about non-competes and non-solicitations, and Malcolm, his perspective on that. But let's talk about closing, because in the context of the corporate world that I live in, we've really got two different paths that we deal with. We either negotiate the documents and sign it and close everything on day one, simultaneous sign and close.
Hmm.
Or then we do have, in fact, we've got a couple right now here at the firm where we sign a definitive agreement, but won't close into some future date, whether it's some conditions that would occur, like regulatory approvals, new licensing issues, key employees that are retained as conditions. What are what is your perspective on a sign, everything's done on day one, this thing's over, versus a sign and future close? Do y'all use a variety? One, what is y'all's take?
Yeah, our preferred is to close as soon as possible after we've done the signing. I think you spoke to a couple circumstances. I think one of the big ones is if there's a license that needs to be transferred, or there needs somebody to be licensed within the business, and that was the previous owner. That's one that we definitely run up against. And it allows for some time flexibility to kind of figure all that out. But yeah, we like to close. I think that's the condition of most, if it's preferred, to be able to just get it done at the time, because they've ultimately gotten to that point of the finish line and they're ready and they're exhausted and they've done all the above. So I think that's the preferred. I think one of the biggest challenges, to get like real practical from a buyer side of perspective,
Mhm.
is when you want to close and you want to take over ownership of the business, and you can't really do that because you haven't wired the funds, you haven't signed all the documents, or they're sitting with some minority partner that hasn't signed, and you haven't got that in place, or whatever the case may be. I dealt with a business that we were looking at to buy that had 18 owners. Imagine trying to get that to sign and close, depending on how they've structured their operating agreement, right? So that can be a tricky situation of like, I'm biting at the bit, ready to go. Maybe the employees even know who we are, they know we're coming, they have an idea, and there's all these little things that happen, and wirings that have to go in different direction, and all this kind of stuff. And so yeah, I prefer it, because if you drag it on, it can be challenging. But at the same while, I recognize there's circumstances that need it, but knowing that as a buyer, I'm biting at the bit, ready to go. So let's get this thing going.
Yeah, people don't realize too. I mean, and again, another conversation for another day. But it's usually not just signing one piece of paper.
Yeah.
You usually have a bill of sale, Simon assumption, flow of funds memorandum, lease assignments. Who knows? I mean, we did a transaction last month that I think there was. I don't know, 33 documents that we had to sign, and it becomes a lot. I mean,
Yeah,
it becomes a little bit of a nail biter there, for those type of transactions. Well, Malcolm, I can't thank you enough for coming in. I mean, this is a passion. We do a lot of complex work for small and medium sized business. And we do, we've got lots of active deals right now, but we don't get to talk about them I
sure.
don't get to talk about them like this. So I can't thank you enough for taking the time out of your day to come and talk about these transactions. I'm sure a lot of people are going, wow, I didn't know, 10% of this, but
Sure.
thank you.
Yeah, my pleasure. Thanks for having me. I appreciate it.
Great. I look forward to, I want to get you to come back on and dig into some more of these topics on another day.
Let's do it. That'd be great.
All right. Thanks for coming on. And for those of you that are watching on one of our platforms on the video side, click the subscribe button so that way you don't miss content like this. If you're listening to us on one of the streaming platforms that we have, same thing. Make sure that you check out our social media because we are on a mission here to educate, support, and advise every startup, small, and medium sized business in the state of Texas. And we do that by putting this type of content into our social media channels, into our private Facebook group so that way you can be proactive in making decisions for your business because we believe that's what will make you actually more successful in whatever it is that you're trying to do. Thanks so much for joining us on this episode. I look forward to seeing you next time when we dive more into these important topics.